maybe one of the most depressing topics we talk about, and we're going to show you historically. This is what the F happened in 1971 is the name of this video. And inflation always goes, my friends, to a select few. It doesn't filter its way to the bottom. And I'm going to prove it to you. And this, look, Austrian economists have said this for years. Inflation is always beneficial to the elites. It's never beneficial to the regular people. It's nuts. All right, so we're going to read a quote from Hayek, Friedrich Hayek. I don't believe we shall ever have a good money again before we take the thing out of the hands of the government. That is, we can't take it violently out of the hands of the government. All we can do is by some sly roundabout way introduce something that they can't stop. And I think these guys are saying Bitcoin. I don't agree with that, but whatever. All right, so let's read my man John Malden. Half a century later, we're still enduring the effects of 1971, where Nixon closed the gold window. But to understand why, we have to understand the origin. All right, so I'm not going to go into the origin of the gold window, but we're going to talk about what happened. Let's see. As the situation worsened, Nixon called an emergency meeting at Camp David, which had the Fed chair Arthur Burns and a young Paul Volcker. After much debate, Nixon listened to the ever-confident Treasury Secretary John Connally, used to be governor of Texas, a Democrat. And so on August 15th, 1971, he ended the Bretton Woods system and imposed wage and price controls on the U.S. CPI inflation was almost 6% at the time. He added import tariffs too, basically the opposite of what most economists would suggest. The dollar crashed even more, and we had to invent the word stagflation to define the widespread misery. And unfortunately, Carter gets a lot of the blame for it, but Nixon needs to get the blame too. Both two peas of the same pod, man. All right, but whatever the cause is, that period, the 70s, seems to have been a kind of economic fulcrum. I'm not the only one to notice it. A host of writers and websites have chronicled the seemingly sudden changes, and that's what we're going to talk about. Hourly compensation grew roughly in line with productivity from 1948 until the early 70s. Hourly compensation. Now, I don't know what was before this. No one would I know about the climate change fakers and liars. You always got to, well, how did it go before that? But either way, from 1948 to 1972, hourly compensation was in line with productivity, and then it kind of flatlined a little bit. It just kind of went over like that, and where productivity went twice that rate. All right, wages rose in line with GDP per capita. Again, they're using 1948 because that's the post-war. I kind of get that actually, because we had the Great Depression. We also had the World War II. So, and then we had World War I. I kind of see where they're going with this, but I always challenge these guys. Like, what was before? It's kind of like they always started the global warming. Look, from 1979 till today, oh my goodness. Like, well, what was before 1979? But anyway, so we can see here, wages rose in line with GDP per capita before splitting in 1970. So here's the wages, the real median weekly earnings of full-time employees. All right, and then it just goes down here, and there's a real GDP per capita, real GDP per full-time employee, average real wage, GDP deflator, average real wage with CPI. And so you can see we have not kept up with GDP, which means we're getting more productive. I mean, some people say, well, that's not good. We're just getting more productive. That's all there is to it. But the wages haven't kept up with the productivity. In itself, that's not a bad thing. The question is it not keeping up with inflation? Income relative to the top 1%, top to bottom. You can see much wealth inequality right here. During the from the 20s, 1920s to the 1930s and such, and then has risen back. Income gains widely shared in early post-war decades, but not since. 1971 is right here, and so the 95th percentile have been making all the bank. The median is up 20%. Real, that's net of inflation. So the median income is up 20% net of inflation. That's real. Real means net of inflation since 1971. The top 95th percentile, or the top 5% essentially, have gotten basically 200 times. The 20th below is basically kept flat. Not good. Income growth. This is what's interesting to me. Look at that, 1971. Income growth from 1910 to 1917 was growing for the 90% of earners, big time. and then it just flatlined, man. And then for the top 1%, it didn't just flatline. Now you can't say, look at that. I wouldn't say there. I would say right there, 1982. So he's trying to make the point 1971. I would say right there is 1982, where the top 1%. Why? Because that's when the markets took off. And a lot of the top 1%, their wealth is from being in the equity market. So people will say that's a negative thing. See, you can't, well, I guess anyone can do whatever they want, but from here it flatlined, all right? But from the bottom 1%, or the top 1%, it flatlined pretty much too. It's just right here it kicked in 1982. I'm telling you, that's not the way you look at it, I don't think. Let's see. We got 50-year decline in wages, share of the economy's total income. And so you can see the drop of the total income. I'm not sure who that was with. That was economists use a Gini coefficient to measure the statistical dispersion of income within a nation or any group of people. A Gini maximum income inequality. All right, so I'm not sure what that means. All right, that says the shares of gross domestic income, compensation of employees, wage and salary. Okay, so share of gross domestic income. I don't get what that means though. Relentless 50-year and wages share of the economy's total income. Okay, so the economy's making money and the employees are only getting 43% of it. So that means going back to the companies. Pablo! All right, I don't get it. Let me see here. Average black income as a percentage of white income, all right? And so you can see 1971, the blacks are going like crazy until 1971. Then it didn't flatline, but it didn't go up very much. It went from 68, well, pretty much flatline, 68 to 73%. That's not good. Look at that, man. It was at 50% in 1948, and it went up to freaking 67%, and now it's still sitting at 73%. That sucks, dude. Thank you, Great Society. Consumer price level. Flat or slow wage growth is bad enough, but worse when the cost of livings are rising. Yeah, but there's still, let's see, on the wage growth stuff, I want to talk about the real income. So, I mean, the real means there's not growing up much, but it is real relative to inflation. So you can't, I mean, there's two different things going on here. You could say CPI, and there was 1971, took off. Well, that makes sense, but the real wage growth takes this into consideration. And this is what I was talking about. The rates of inflation were low until right about, I mean, this is when we introduced the Federal Reserve Board. Now, this is not logarithmic, all right? So we don't have, it should be 0 to 5, 5 to 10, 10 to 20, 20 to 40, 40 to 80. They're not doing this. If you did log, it'd be a whole lot different scale. But you can still see the massive amount of inflation has taken off in the last 50 years. Owning your home is supposedly the key to financial success, but after the 70s, home prices in major cities rose far faster than income did. Median house price in New York in 1971. Median household income in New York, about the same. Median house price in New York is way up here now. Median household income in New York is way down. So you can see, but it has a lot to do with lending standards, not requiring a 20% down payment, all that stuff as well. But without question, and also lots of restrictions on building. I mean, just have they built any new homes in New York City? I mean, it's all, I doubt. But that's another reason why people move to the suburbs. They can buy a freaking house, man. You can debate some of these numbers and their sources, but the clear is that the 1970s were a turning point in the average American's financial condition. I completely agree with that. Most people derive their income from their employment. That's why unemployment is a problem, but that's why people want better, high-paying jobs. We say the path to a better job is increase your skills. In an ideal economy, every worker would match with a job that fits their particular skills. Unfortunately, we have barriers. In the 1960s, there were efforts to remove race as a barrier. Yep. And what I'm saying, litigation, okay, this is the 19th Supreme Court, right on. When government makes hiring people more difficult, employers will find ways to hire often fewer people. Exactly. They might start squeezing more productivity from the workers they already have. Look, I got people who text me or email me all the time. It's like they let a couple people off. Now I got to do the same work as 3 did before. All right. Do these degrees really deliver anything employers need? College degrees. Sometimes we have to establish a system in which people think they need a degree, any degree, just to get a foot in the door. They're not wrong. Those who are employers know this works. Some highly skilled positions are hard to fill, but they tend to be those where all the applicants have degrees anyway. So education is not the factor, I'm telling you. Back in the 1980s, up until the mid-2000s, but especially after that development of online job websites, I would advertise for a job and get lots of applicants. I remember once getting 300 applicants. A college degree wasn't really necessary. Skill were, but we had to sort through 300 applications. It was easy. Just start with college degrees. Even if someone's degree is far afield from what you do, the fact they have one gives you some useful information. You know they are willing to sit in a classroom, turn assignments, take tests, and otherwise go through a defined process to reach a goal. These are helpful. The problem is those skills aren't unique to college graduates, exactly. The jobs problem is really a data problem. College degrees have become a proxy for the IQ tests that were made illegal 50 years ago. They aren't a particularly good proxy, but large employers lack better options. This is an economic problem for everyone. People contribute more to growth when they are deployed efficiently in jobs and their particular talents and goals. Businesses filled with workers who are just there for a paycheck tend not to produce much and may even be a net drain on the economy, 100%. All right, so let's keep looking at, so you got anything more in here? All right, cost of living. Yeah, right here. So you can see new house, $25,000, 1971, average income, $10,000. Vitamin D milk, buck. I've talked about this before. I'm not going to that. I think that's interesting. But let's go back to WTF Happened. There's a couple ones on here. World per capita energy consumption right there. You can see it's kind of leveled off, man. We're consuming energy look at that. That's pretty interesting. Anyway, there's a couple ones I want to show here. Energy consumption per capita, 1 kilowatt, of course, equals 8,766 kilowatt hours per year. So you can see actual energy use leveled off. I can't see what that one says. Adams curve. Henry Adams, I'm not sure what that is. Now, the actual energy use has leveled off, which is good. And more efficiency, LED lights. Look, I like it. I can't read what some of this stuff is. Interest rates since 3000 BC. We had that one time was way up here. I'm telling you, man, the rates are low rates. I think are here to stay. I really do. I just want to show you a couple things. Goods trade balance. The cost of a barrel of oil in nominal terms. That just shows you the volatility of inflation right there. Since we got off the Bretton Woods. Net savings, a percentage of gross national income, and I always challenge this, does it not include Social Security? I just wish this is a number I just kind of take issue with. We weren't paying 6.2 on both sides of the equation back then, so I don't know. U.S. personal savings rate, they say it's going downwards. Well, I don't know. But speculation, volume of futures trading, look at that. Industrial production, all speculative. The markets are speculative. Working hours to buy the S&P 500. Wow. Average is 30 hours to buy the index. Look at that, man. And we're up here at 120. Just shows you how high the S&P 500 is. The Shiller price to earnings ratio, S&P PE ratio. But that's not what I want to show. One sec. Yeah, here we go. Right here, federal deficit to surplus. Basically nothing. We had no growth. We had economic deflation in the 1870s, deflation all through there. We had World War I, then we had some inflation to offset for World War I, Great Depression, World War II, and we had some growth to offset that. And you can see we haven't had any. We had right here 1996 under the Republican Congress, or 1997 and 98, and Clinton as a president. That's what you really want, man. You want a divided Congress or a divided government for sure. And look at this. I mean, this is not sustainable. We're not even in a war. I mean, I guess you could say we are, but this is not good. And that's before 2000 freaking Sniffy Joe stuff's coming around. U.S. monetary gold in tons. Look at that. External dollar liabilities. Yep. Official liabilities. Off the record budget or off budget debt. This is a big one right here. I wish this was logarithmic, but still. National debt in trillions of dollars. This could go 1 to 2, 4, 8, 16. That's what it should do. It'd be a whole lot different, but maybe I can find one. But you can still see. Look at that. I want to come back to this because I think it's important, actually. Let's see. Gross debt, federal debt held by the public as a percentage of GDP. And so you can see the public holds 75% of our debt, I guess. Yeah, about 75% of the debt as a percentage of GDP. So the public hold, as a percentage of our GDP, if we have $1 worth of growth, the gross domestic production, there's 75 cents that the public holds in debt for that. Now, that's not the total debt, by the way, right? Because there's more debt than that, too. Federal deficit debt as a percentage of GDP, they're predicting 180 federal debt to GDP. Well, Japan's already at 250. So that in of itself doesn't say, oh my goodness. There's another one in here. Currency crashes. All major currencies have depreciated over the past century relative to gold. Yep. Hyperinflation, gold reserve. Australia total mortgage payment. Okay, that's not what I want. Maybe. Oh, we talked about this. Median house price, electricity, food, and fruit, CPI. So we got to assess. Fruit has gone up. See, you can make your own fruit. You can just plant a tree, man. It's frustrating me. All right, consumer price index. This is what I want to talk about. Again, not logarithmic, but you can see, it was going up a little bit, but then boom, took off like a bat out of hell. It's crazy. All right, so let me pause this real quick. Here's a U.S. federal government debt in log graphs. All right, so we got -1 to 1, 1 to 10, 10 to 100, if that makes sense. So compare that to this right here. Hold on just a second. And it's just, look at that. All right, so here we're starting out at 0. You see what I'm saying? So that's a big difference to compare. I know this looks ugly, and it is. But when you do it logarithmically, if that's even how I say it, it's significantly different. It's significantly, our whole sec. Here, the difference real quick between log and arithmetic or algebraic. I can't remember what it's called. I think it's arithmetic. Anyway, so this is the non-log for the S&P 500 since 1928. All right, you can say, whoa, look at that, my goodness. But then if we do the log, a little bit different, isn't it? I mean, it's still going up like that, but you see 255, 5 to 1, 1 to 2, 2 to 4, as opposed to, that's the logarithmic way you look at this. And that's the way you got to look at it. You just got to look at scales for sure. And this is why I like macro trends. Not all the charts they have are like that, unfortunately, though. I thought they had one, right here, earnings history. Let's see if that does. I couldn't find one on debt. I didn't look that hard, but I couldn't find one on debt. Yeah, this one does do it, but I showed you that. So at the end of the day, before you start freaking out about the debt and all that, and you should, I mean, without question, this is not sustainable. Just remember to put it in the right perspective, if that makes sense. What used to be in a chart isn't the same today if you look at it to scale. All right. Anyway, but still, it's probably the scariest chart you're going to see. 1971, Nixon, and we're never going back, unfortunately. All right, we'll see you.